Patrick Findaro here, co-founder of Vetted Biz. Dave Ruby is our guest today, a seasoned SBA lender, specifically focused on SBA loans for about the last decade, but he has 20 years of lending experience. Dave, thanks so much for joining.
Yeah, thank you very much for having me. I really appreciate it. As you said, Patrick, I've been a banker in the St. Louis market for about 20 years. Started my banking career while I was in college, did some retail lending, commercial lending, and then kind of transitioned into the small business SBA space about 7 or 8 years ago, 100% of my time. So it's always been something I've done, and we'll kind of talk about how SBA lending works. But I saw such a neat opportunity to help, I think throughout the last downturn, helping folks that wanted to buy companies or start companies. And then now, obviously, as probably overused term, but baby boomers that are looking to sell companies, the SBA ends up becoming a great financing mechanism for those type of opportunities. So I think I saw that opportunity. I somehow have a really good attention to detail in just how I operate my business. And that kind of lends itself well to SBA lending. So it was kind of a perfect storm. And I joined the bank I'm with today back late 2021. So I work for a very small community bank called the Bank of Houston. We're headquartered out of Houston, Missouri, which is in a kind of a rural part of Missouri. We have loan operations here in the St. Louis market, and that's kind of where I live and work and operate. But we also do national lending. So it's a neat opportunity to be part of a really small organization that's dedicated to SBA lending and growing in that space.
And looking at the top SBA lenders, and it's all public record through FOIA requests with the SBA. Yeah. Now they put it up on the website, and we also make it easier for people to see it on Vetted Biz and make sense of the data, but a lot of not household names. You don't see JP Morgan Chase on the top of the list. Really, none of the big banks in the top 20. Why is it these smaller community banks that are the lender for small businesses?
Well, it's a really good question. I've always worried about the day when the big banks figure out how to get out of their own way. I kind of came from the big bank world, spent a lot of my career at a bank called Regions Bank and Union. Oh, yeah. Well, it was Union Planners prior to Regions when I started my banking career, and then PNC Bank. Both of those banks are banks that do SBA lending, and in some markets, they actually do really well. But at least I don't know what the reason for it is here in the St. Louis market. It seems like it's smaller community banks that really dominate that space. And I think it's teams that they understand what the program should be utilized for, which is helping small businesses, whether it's starting companies, growing companies, creating jobs, but doing things that are good in the local market. So community banks seem to have embraced the program to the full extent of what the program can do. Whereas a lot of the large banks, they'll do SBA lending, and they may even have a team dedicated to it, but they're going to have a list of what they won't do. So they're not going to do startups. They're not going to work with companies that are under 3 years in business. They won't touch restaurants. They'll have kind of a list of industries that they stay away from. So they kind of carve out a niche within the SBA that's kind of their safe space. Whereas banks like ours, we look at everything. I mean, I'll finance a restaurant if it's the right opportunity and if it's prudent lending. So we don't really have our credit policy is really that we utilize the SBA standard operating procedure, the SOP, and then we apply prudent lending to it. I mean, that's to simplify our lending policy. That's what it is.
Very cool. Thanks for breaking it down in such a concise way. So, I mean, our listeners are prospective franchisees, current franchisees, franchisors, all different types of personas. But there are a lot of folks that it's their first time going into entrepreneurship, and they're investing $100K, $200K, including working capital, the franchise fee, everything needed to essentially break even on a startup franchise. When do you advise them to get in contact with you, Dave? Is it when they're about to sign the franchise agreement? Is it earlier in the process? When does it make sense to engage with a lender like yourself?
Yeah, I mean, I tend to think earlier is better. The earlier you can have that conversation, understand that you're with a lender that kind of understands what you're looking to do and has experience in that lender is always key. Sometimes I meet folks that are just at that exploratory stage where they're, hey, I'm working with a franchise broker and I'm looking at, 5 different companies. What are your thoughts? Can you evaluate my personal financials and make sure that if I choose one of these, that I'm going to be somebody that's qualified enough? And I've done that. I've also met people where, hey, I signed the franchise agreement. I already paid my fee and I need financing quickly. So, the answer is probably somewhere in the middle there, not the person that's just tire kicking for the next 2 years and not the person that's, owes their franchise fees next week. But I really don't think it's, once you get serious about going that model, whether it's the franchise model or looking at acquiring a company or growing a company, I think it's always a great time to get in touch with a lender that's qualified. And kind of to your point, you brought up that the lists are public information. So if you go to the SBA website, I think they refer to it as the district office lender report. So a borrower can kind of go to their region of the country, find a list of lenders that are proficient in that market, and really kind of select somebody that they think is gonna be able to help them. And I even jotted down some stats on the St. Louis area to kind of give you an example.
Would love, enlighten me.
Yeah. So if you were to pull up Eastern Missouri, so St. Louis is on the eastern half of Missouri, so we fall into the Eastern District. It's kind of Columbia, Missouri, mid-state. To the east is that region. Then there's the Western Missouri region, which would include Kansas City. Well, within our region, if you look at the 2020 result or 2022 results, you're going to find that 32% of all SBA loans made in our region were made by, it was 4 community banks, made up 42%. The rest of the loans were made by 85 other lenders. And those 85 other lenders, the majority did 1 or 2 transactions.
It's like you don't want to be the 1 or 2 because that lender, whatever that advisor, whether the advisor is a franchise broker, an attorney, whatever, they're kind of learning as they go along with you. Where if you do serious volume in whatever trade, you're in your case, specialized SBA lending, you're not learning from that particular. You are always learning, of course, but you already know, and I'm sure it can just get approved. The process is going to be a lot faster.
Well, I think if I had to say what and for the listeners, we were the number 1 SBA lender. So our first year in this new team, kind of growing this community bank's SBA presence, we finished on top and had a great year. I think our competitive advantage is, one, we're dedicated to it. The majority of our bank's focus is on SBA lending, and that's really where we're driving profits and growth to the bank. I think the second is community banks tend to be a little bit flatter of an organization. So your lenders and who they report to, that chain of commands is smaller. So if there's a transaction that I'm working on where I have some question about our ability to get it done, I can speak with my CEO, the guy that kind of leads up our credit division, and have a conversation about it.
Not even the credit officer. You can go right to the top guy and be like, hey, is this something that is in our risk appetite?
That's exactly it. So
it's a huge
So
difference.
It really helps community banks kind of be more proficient. Whereas if I'm doing 1 or 2 transactions a year, I'm having to relearn the program every time because there's always changes to the program. So yeah, that's been kind of I guess if I had to say our key to success is that right there.
And what time frame are we looking at? So imagine someone, that persona, they're investing $200,000 in a business all in. When they start their process with you, imagine they have all the paperwork set. They've already signed the franchise agreement. How much time are we talking about more or less to get funded?
Yeah. So I'll kind of break it down because there's a couple steps to the process. Step 1 is, let's have a conversation, whether it's over the phone, in person, some sort of platform like Zoom. Let's discuss the opportunity. I can pretty much know there whether or not it's something that's going to fit in our wheelhouse. From there, if I'm like, hey, this sounds like something we can get done, I'm going to encourage that applicant to send over all the financials. I'll send a very clear, concise checklist of what we need. I always joke around that my clock starts ticking the day I get that checklist. Once I get all the items on that checklist. There's not much you can do
until you have the information.
Exactly. I mean, sometimes I'll get piecemealed stuff, and until I kind of get a full and complete package with all the application documents, it's hard to dedicate my analyst time or our credit division's time to get that write-up done. But from the date I get everything, we're generally about a week to a week and a half, depending on the complexity of the transaction, to issue a commitment letter. So that's hey, congratulations, we've committed to funding this transaction. Here's the list of what we need to close. Typically, I would say 45 to 60 days is probably our average from that point the things that cause delay are not generally the bank or the SBA. It's generally third-party stuff. If it's let's say the business requires a lease space. Well, they have to negotiate a lease. There's certain lease subordinations that the SBA is going to expect that get executed. So there's some negotiating time with a landlord and reviewing changes back and forth. Life insurance. If the transaction is under collateralized, the SBA is going to require some level of life insurance. So getting approved for policies, getting a collateral assignment on that life insurance. So usually it's these third-party vendor items that delay the process. If it's the SBA or the lender, oftentimes it's the wrong lender because they may not know the program and maybe they're not being clear and concise on what's needed.
And how can you combat that? Is it just really case by case? You mentioned two pretty significant things that I feel like you could do earlier in the process. Yeah. Lease negotiation, sometimes out of your power, and it's gonna be different if you're negotiating with a REIT or you're negotiating with a high net worth owner, property manager, et cetera. But the life insurance, if everyone knows that, is that you bring awareness to, or people bring awareness to kind of get that in order?
Yeah, I would say, probably 90% of the time we're having that conversation on the front end. If it's a business startup where we're going to have some significant collateral shortfall, we'll bring up that idea that, life insurance is something that you'll want to have in place. We can even recommend some firms that specialize in issuing life insurance or term insurance quickly. Truthfully, we don't always know the exact amount of life insurance until we've underwritten it. So, for example, somebody starting a $300,000 franchise, if they have $200,000 worth of equity in their home and we have to take a lien on that to be collateralized, our requirement may only be $100,000. Whereas if somebody has no equity in their home, it may be larger. So the exact dollar amount is always case by case, but that shouldn't prevent a borrower from starting the underwriting process.
And do you have a threshold where it's just too small of a loan for worth your time, worth your bank's time, or will you do SBA loans on the very low end?
Yeah, I mean, that's a tough question because the SBA can make loans of all sizes. So it's hard to be a top SBA lender and say we're not going to help people. But to be honest, $150,000, $200,000 is going to be the low end of what we do. It's a labor intensive process, and running a small business like you have there, when you start dedicating a great deal of time to something that doesn't generate revenue, it's kind of a drain on your tools and your resources. So usually that's kind of where if it's much smaller than that, it really doesn't make a whole lot of sense.
That makes sense. So you would say $150K would be kind of the low end threshold.
That's going to be the low end. And again, we've helped folks with loans lower than that. Kind of comes down to the complexity. If it's somebody that, they've got 20 different affiliate companies where they've got ownership and other entities that we're going to have to underwrite, and it's $100,000 request and we can't make sense of, that's not going to be a great use of time. Whereas if it's something where, it's a husband-wife where husband's maintaining his job, wife is going to start a company and it's small and they need capital and it's pretty clean cut, then that's something we may be able to get done pretty easily.
That's good to know. So it's going to, the volume and then just the complexity of time. There are obviously a lot of businesses that viewers in Vetted Biz are starting or already have started, like preschools, healthcare related franchises, food franchises, where they're developing multiple units, and it's going to be in the millions. Have you found the underwriting process to be easier when it's a franchise resale, an acquisition of a franchise versus a ground up?
Yeah, I think it's a lot easier. It's one thing to read through a franchise disclosure document, an FDD, and try to make sense of, especially if it's an out of market transaction, is this town in this city going to perform, on the lower quadrant, mid quadrant, high performer? It's hard to know that. So on those kind of transactions, we're putting a lot more of our lending weight on the individuals behind the transaction. So if it's a startup where we have nothing but projections, we're going to look at the guarantors a little bit heavier and their ability to make payments if the business is slow to ramp up or fails to hit projections. Whereas if it's an existing, a resale, and we have historical financials and we can make sense of what the cash flow looks like, it's very easy to kind of back into what a reasonable loan amount would be.
Dave, are there times where someone's doing an acquisition, whether it's a franchise resale or buying just an independent business, where the asking price does not match up with the seller discretionary earnings, and you have doubts that he's going to be able to pay back the loan?
Yeah, we're seeing that. Sadly, we're seeing more and more and more of that in a rising interest rate market. I think one of the biggest things we're seeing are sellers, they want to get paid, based on last year or the year before's multiples, and they want to be paid these high multiples. Buyers may be willing to buy the business because they like it, but when you start applying today's interest rates, their buying power has been minimized. So that's definitely a challenge. When we're in that solution, or when we're in that situation, we really look at kind of three solutions. It's either more equity gets injected by the borrower, seller reduces their sale price, or the seller agrees to carry some sort of debt on a separate seller note. So we do bank financing. So if it's a $1 million acquisition, but we can only get comfortable financing $600,000, if they work out reasonable terms, and there's all sorts of solutions there on that side, then there's still a way to get the transaction done. But the problem is we're seeing those kind of conversations we're having today. They're leading to the sales cycle dragging out, more negotiations between buyer and seller.
Because ideally this would have happened earlier, where they come to you and they say, okay, I'm going to put 20% down. He's going to seller finance 10%. And we just want you to do the 7A at the 70% of the capital stack. That's $700,000.
Well, and the other problem too is not all buyers are created equal. So I've worked with buyers that may be buying a company from a seller. When seller discretionary earnings, it's your cash flow, it's your EBITDA, but then they're adding back things that are at the discretion of the seller. Oftentimes you're going to see large salaries. So it might, if the seller was taking a $200,000 a year salary, but the buyer only plans to take $100,000, from a cash flow perspective, we're adding $100,000 of cash flow back. In the scenario where you've got a buyer that maybe has a pretty high cost of living and they need to take every dollar of salary, that becomes a problem from a financing standpoint, but it doesn't necessarily mean that the business is overvalued. So, we have to take those things into consideration. So I always prefer when we have a buyer that doesn't need to pull excessive salaries out of the business to maintain a lifestyle. Oftentimes when they have a working spouse that has outside income, that's going to help solve that, because they can take a minimal salary, especially during the transition to make sure everything transitions smoothly. But yeah, it's a struggle we're seeing today in today's interest rate environment.
And as part of the application process, I imagine they're doing a personal income statement, personal balance sheet. And from there, you can see kind of where they're at in terms of their spending and earning habits from just the personal side.
Correct. Yeah. I mean, that is one of the things we look at, are their personal obligations in line with what their lifestyle has been? Have they earned enough income to support the lifestyle they have? Sometimes we see the folks that are living, a phrase a coworker of mine likes to use is too high on the hog, where they've got all the fancy cars, they've got a big house with no equity, and they're spending every dollar that they get.
You see that in
Those
Miami.
are harder transactions. What's that?
You see that in Miami. It will be like kind of a rundown apartment, but there's a Porsche out front.
100%. I mean, we see borrowers that we see some silly stuff from time to time. So, the business cash, in my opinion, is the business cash flow, if it's a good company, shouldn't be solving personal issues. The person should be somewhat solid that's buying the company or starting the company, and this is going to enhance their lifestyle, not bail them out.
Well said. Do you have any advice from your experience for small business owners that are struggling to secure funding, especially in this high inflation environment?
Yeah, I mean, again, it kind of gets back to having a relationship with your bank. So if you're a business owner that's operated well, and now you're being squeezed by higher interest rates, and your banker, your current lender, is not able to help you, I do think that's a great time to reach out to an SBA lender. And as I mentioned, finding somebody that specializes in it may be able to help. There are times where within the SBA, obviously, we can help, boom in good economic times, but we can also help people that may have had hard times. So I kind of look back after the last recession, there were good companies that, during the recession took on debt. They took on high interest rate debt, short-term debt to try to keep their staffs employed, not knowing how long the recession was going to last. Well, you fast forward a couple of years and the company's sales have rebounded and they're back to a point of profitability, but now they're drowning in high interest rate debt. And they keep robbing Peter to pay Paul. So I've been able to work with companies like that in the past and help them restructure the debt. The SBA allows for, kind of a consolidation of that as long as it was used, as long as we understand what the funds were used for. The SBA will allow us to refinance that into a 10-year term, which can greatly improve cash flow and allow a borrower to start paying that down quickly. What
are some red flags that the buyer of the business doesn't pick up on, and maybe even his accountant, if he had an accountant do the due diligence, doesn't pick up on, that you and your team as underwriters spot as red flags that you're not confident that the new buyer, the new owner of this business is going to pay back the loan. Thus, the structure it is and potentially the business as it is does not make financial sense.
Yeah, I mean, I think some of the things that we look at, or when I see red flags in it, and you're talking more in an existing business,
where business.
The buyer's looking at it. One of the things that I'm always surprised that I feel like buyers don't get into until later on in the process is customer mix. Just really understanding what is the company's sales made up of. I always like to get a couple years worth of, customer sales by revenue, and then kind of match that up to the total revenue and be able to pick up on any customer concentrations that may exist. I mean, if you're transitioning a business, there's risk involved in that. But if that business, 40% of their revenue is made up by 2 or 3 customers, and they really liked working with the seller and they don't like the
one
buyer.
Of the guys is a college buddy or even a related entity of the company. And you see some pretty bad stuff where, one of the big customers is actually just owned by, a related entity of the beneficial owner.
Yeah. It's, these are definitely things that we have to look at and kind of keep an eye out for. And I think that's where we get a little bit deeper. And again, the level of diligence gets deeper, the larger the transaction, the more goodwill, the less operating experience of the buyer, those sort of things. But I think that's one that, I always like to see what sort of customer mix is there. Working capital needs as well. Just trying to understand, is the business pretty level or is there a lot of seasonality to the business? And depending on the time that the buyer is buying it, they could be walking into a season that they need capital to fund and run their business. So oftentimes getting, monthly P&Ls for a seasonal business, as well as monthly balance sheets, will help us kind of figure out if we're plugging enough working capital into the transaction. So those are some areas that I feel like borrowers miss.
Are there opportunities here for someone to come in and buy a struggling business? So a lot of the sandwich franchises, for example, defaulted. Like there were 10 plus Jimmy John's franchisees, a lot of Subway franchisees, even Fire a Sub franchisees that defaulted. Is there a way that sophisticated operators can go in and buy the debt from the SBA lender? How does that work out in the workout process? The SBA loan goes bad. What are there opportunities to be had in 2023?
Yeah, that honestly, knock on wood, I have not worked through liquidation of bad loans in my career. I've always been more on the generation of new loans side. So I can't really speak to the legal opportunity there. I do think there's opportunity that as there's struggling operators out there, or operators that are maybe too leveraged that the debt's hurting them, and you've got, experienced operators that are low leveraged and performing, I do think there's opportunities where we can make new loans to those existing operators to buy out the ones that may be struggling. I actually helped, you mentioned Firehouse Subs a few years ago. I helped an operator start their first location. So they were new to the franchise model, started their first location, were extremely successful, very good at what they did, great guarantors. They found another opportunity within their kind of the greater market where they could add on and bolt one on. And that one wasn't performing well, but they were able to run some of their projections, kind of compare it to the store that they were running successfully. And we were able to fund that one based on projections. It wasn't just based on historic cash flow. We could kind of see where things were mismanaged. So yeah, there's definitely opportunities like that.
I think 2023, it makes a lot of sense starting a business from zero, service-based business. But for a business with a physical location, that construction costs, labor costs, permits times aren't getting shorter.
Yeah.
It's hard to decide to do a new build compared to an acquisition of a franchise. And especially as there are so many people retiring and there's great franchise systems where there are franchises available. And talking to you today, I mean, from a finance perspective, it is easier, whether you're buying one existing franchise or you're negotiating with an operator that it has three to get the deal funded and get going.
I agree. I mean, I think that's one of the things I struggle with new franchise operators that are deciding to do something retail or physical location based is that, you hit the nail on the head. We're almost always seeing construction budgets exceed what they're anticipating. We're seeing the initial, equipment package or FF&E package exceeding the costs. And oftentimes the projections are prepared, today folks are preparing projections off of 2021 or 2022 FDDs that are based on the prior year's financials. So,
so we're going back a few years now.
Yeah,
there's been serious inflation across those costs, across all those categories.
Yeah. So when we are underwriting those opportunities, we're having those conversations and, behind the scenes from a credit standpoint, from a bank and prudent lending standpoint, we're already having that conversation. Like, do the projections, do the guarantors, are they strong enough that we feel that when we see these increases in construction budgets or when we see that equipment costs have gone up, that we're still comfortable financing this transaction? Because if we just said no, the first sign of the project budget going up, we'd probably all be wasting a lot of our time.
I see your incentives are aligned with the buyer because you want them in a good business that they'll succeed. And they'll ideally grow and go seek more lending facilities to continue their growth. But you're going to spot the red flags and you're going to tell them. And if they want to shop around lenders and they want to dismiss the red flags that you cited, that's on them. But I'm sure that you can offer really a lot of support for those that are going to acquire an existing business franchise or even a startup franchise.
No, I mean, I think, again, we see enough transactions. We work across all industries. We work on large transactions, small transactions. I think when we do start to look at a package, whether it's a startup or whether it's an experienced business that's being acquired, oftentimes we're going to ask questions from our experience. So if you find a quality lender, somebody that's experienced in this world and genuinely wants to help. I mean, I always come of the mindset, I want to find ways to get things done in the city. Like we use the example of what if the business is overvalued? I'm not just saying no, I'm saying, I think we can get this done. Is there a way to kind of solve for that delta that we've got between cash flow and purchase price? So yeah, I mean, I think there's definitely ways to help folks in that regard.
So you've gone through so many different loan sizes in the millions of dollars, even smaller loan sizes for businesses, all different types of industries. Is there any commonalities you see across successful companies, successful businesses that you've underwritten?
Yeah, I mean, I think it's probably twofold. It's, cash flow is number one. I mean, companies that have been able to manage debt, have good, strong cash flow, and be able to kind of deal with good times and bad and some seasonality in a business, that's always, huge. I think another is just the individuals behind the business. How are they living? What's their lifestyle like? Are they living within their means, or are they taking every dollar out of the company or leaving liquidity for those unknowns? So, I mean, I think those are some of the biggest things that I look at when I start looking through a package for, whether, again, a startup or an acquisition opportunity.
And yeah, you brought up, I mean, a lot of people are focused on EBITDA, but unless it's like in the private equity space and larger space, I mean, at the end of the day, it's cash flow.
Yeah.
And I've analyzed a lot of franchise opportunities recently, especially in the gym space, where every 3 or 4 or 5 years, you're replacing the equipment or there's heavy capital expenditures.
Yeah.
And the seller discretionary earnings is not going to reflect that for the last year. So you're going to have to be reinvesting a lot of money back into the business. And at the end of the day, that's cash that you're not able to pay down your loan and pay yourself.
Well, and I've seen that a lot in the, call it the trucking space. I mean, that's a space that's exploded through COVID and more trucks on the road hauling more goods. And what we've seen are these companies that have had to continue to add trucks, trailers to keep up with the demand. So every year they're writing off this large depreciation, which from an EBITDA standpoint is getting added back, but not hitting them with a reasonable CapEx expense is not doing a buyer any justice whatsoever. Because if you see this large depreciation year over year and the company's having to replace and repair trucks year over year, that's not going to stop the day a buyer comes in and buys that company. So I think that's another area that when we talk about red flags, kind of gets missed. The way calculations are done for EBITDA or SDE versus what practical cash flow post-transaction are going to look like, they can be completely different.
And yeah, we're dealing for vetted business, mostly providing data to more financial buyers that are looking to invest $100K to $5 million in that range for a business that's going to provide for their livelihood. And they're not as much a strategic buyer who is buying that trucking business because they want to enter in that state and they don't mind paying some crazy rate. And they understand that it's not as much about the cash flow, but it's about a bigger opportunity and synergies.
Yeah. And I'd say we're in the same space. I mean, in the size range that we play, small business space, it is more the buyer that is going to be kind of that financial buyer that's going to work in the company. It's not, we've done some bolt-on acquisition type work, and I'm not saying we don't do any of that, but most of the times we're taking out, a seller that was taking a salary and working in the business, and we're plugging in a buyer that's going to take a salary and work in the business. And we need to understand what that transition period is going to look like and why that buyer is going to be successful in there. And can they repay the loan? Probably the most important thing that I can look at.
There's a lot of moving parts.
Yeah.
But I guess if you don't, you learn just through sheer volume and also, being aligned and having open communication channels with your CEO, the risk officer, where at large organizations, especially if they're not SBA focused, they're kind of going to be more siloed in their approach of how they make deals.
I'll never claim to be an expert. I always joke around, I'm more like an attorney. I'm just practicing SBA lending. I'm kind of learning every time I go through transactions. But I think doing the kind of volume that we've done, and I've done historically over my career, you do get a good sense of what makes sense and what doesn't. So right off the bat, if the cash flow is really tight on a transaction, I'll know before I even go to anybody in my leadership team what the right size loan might be. If the cash flow, and you'll hear bankers throw ratios around, if it's a 1.2 debt service coverage, that means there's $1.20 of cash flow for every $1 of debt required payment. That's not awful strong when you start looking at a large goodwill acquisition with a company's financials that can ebb and flow from year to year. So that's kind of the unknown science behind SBA lending, is we really have to figure out what is the right debt stack here to make sure that our buyer can be successful long term and that they're not going to be over leveraged.
I know it's super holistic, but what do you see like for a business that's doing, from debt, like that debt service to cash flow ratio? Like what's like a better number than?
Yeah, I mean, and again, it's going to ebb and flow from year to year because business doesn't spit out the exact same amount of cash every year. Most don't. Typically, when we kind of average it out, I'd say on the lower end for a goodwill acquisition where we're not going to be fully collateralized and there's going to be some level of goodwill, 1.4, 1.5 debt service coverage. So $1.40 or $1.50 of cash flow for every dollar of debt. That's going to probably be reasonable. If it's a weak guarantor, somebody that maybe has a lot of operating experience or maybe works in the company but doesn't have two nickels to rub together, but they're the best potential buyer because of their operating experience, we're probably going to want to see that debt service coverage in the 1.8 to 2 times. Yeah. So there's a lot of room for error through the transition, or there's, COVID 2.0 hits and sales decline for a period of time. They'll be able to weather that storm.
Definitely. And, SBA publishes charged off rates by bank, and it doesn't tell the full story because that first persona at the 1.4 ratio, he has a home, he has a second house. He sold the second home to pay down the SBA loan. So it wasn't a charge off. He paid his loan back, but the business struggled or failed. Where that other guy, the manager of the business that's doing a management buyout, he doesn't have the assets to sell off, and he's going to definitely be more likely to charge off. And I'm sure that's why you want to protect it, to make sure that the business,
you want there to be less room for error. You want the company to be able to kind of stand on its own, even if they mess some things up along the way through the transition.
Well, Dave, any concluding thoughts for prospective franchisees or business buyers, or even existing business owners, and how they can potentially benefit from some of these SBA loan programs?
Yeah, gosh, that's a good question. Let me think on that. I still think the trend of these, and again, I hate overusing the phrase because they're not all baby boomers, but typically there's a lot of baby boomers or older generation that are going to be selling. A lot of these companies, from what we see, are very low leveraged, which means they don't have to be awful efficient because they don't have a bunch of debt to service. So we find that these companies may be, lacking in what they're doing from a sales perspective, that they've just been fine with the status quo, or they've got really archaic technology or, inventory systems or ordering systems or whatever it might be. So I think for good qualified, individuals that are looking at buying or starting a franchise, there's going to be a lot of efficiencies that can be taken advantage of in the future. I think, improving sales channels. I worked with a company recently. It was a small manufacturer where the company made money year over year, despite their kind of inability to really run the company. There were some issues on their end. The buyer came in, hired just a rock star salesperson, created a really good technology system to track inventory and order management and everything else. And the company is absolutely crushing it. Now he's looking at potential bolt-on acquisition opportunities. So those kind of opportunities exist in today's world. That's one model I would be looking at. But again, a good franchise where the model is working and you've got maybe an older seller that's just ready to kind of move on to the next chapter of their life, for the right buyer, stepping into a franchise model where they're going to have, kind of a playbook to follow, plus experienced operators to help them transition for a period of time. I think that's a great opportunity as well.
Yeah, I think you said it super well. And that's been my thesis. 2023 is really the year of the resell. So whether that's an existing business, any type of physical business, there are good deals on the market.
Yeah.
And on the franchise side, understanding that what gets listed on Biz Buy Sell has been looked at so many times, because usually everyone in the adjacent franchisees in the area, like your client from Firehouse Subs, he gets the first take. He gets the first look at the business. And it's going to be a much easier transaction for the seller and the franchisor to approve off. So the franchise resells, if you're interested in a brand, contact the franchisor. If you're working with a franchise broker, have the franchise broker contact the franchisor, and just let it be known that you're open to opening a new business, or you really want to focus on a resell, and that you have the time to wait. But the fact that it's easier to finance these deals as well, and that you have Dave's team that's underwriting it and providing a second level of essential vetting on the customer mix and a lot of these key factors that you would have to pay an accountant, $4,000 or $5,000 to do those type of studies. So
that I will say that's a really good point. It's something I always joke around with my borrowers on. My services are free until we actually close a loan and start charging interest. So, don't abuse it, but feel free to reach out to me, have me review financials with you, take a kind of a first look before you maybe get down the path of engaging attorneys and accountants. Experienced lenders should be able to evaluate the financials and at least give you some high level, meaningful thought. If you're not getting that from your bank, it's probably time to start looking at a different lender or somebody that really specializes in these kind of transactions. But yeah, we've probably saved folks a lot of money just by saying, hey, this looks like an issue. Why don't you ask this question? And then they find out, this isn't as appealing as it once was.
So Dave, what's the best way for someone to get in contact with you?
Yeah. For sake of this meeting, let's say my email address, which is druby, D as in David, RUBY, B as in boy, at thebankofhouston.com. So druby at thebankofhouston.com. You can also friend me on LinkedIn and shoot me a message that way as well. Or if you forget, you can reach out to Patrick and hopefully he'll be kind enough to direct you my route.
Definitely. Yeah. You can email me at patrick@vettedbiz and we'll connect you to Dave. Dave, thanks again for being on.
Yeah, it's my absolute pleasure. Thank you very much.